Okay, now we're live. So I am here with Josh Flores. He is a lender with Supreme Lending. Josh and I have been working together for years, and we do a lot of purchases together. So we want to talk about kind of some shifts that are going on in the market as far as interest rates, what you can do about it. Is now a good time to buy? Kind of what kind of loans people are getting, and then also want to talk about what is happening in the market right now. Like, what are we actually seeing for as far as prices and things like that? So, Josh, what I am really so we talk a lot about rates, and even now when we have some listings, we are seeing that sellers are giving like a credit to buyers of like $10,000, $15,000, and mostly this is to buy down points and help them get a loan. Can you kind of talk about that? Like, what are points? How do you buy them down? All that good stuff.
Sure. So just kind of starting at the beginning, like what is a point? How is it calculated? That kind of thing. And a lot of the folks watching might already know this, but it's always good to make sure we have the basics. So 1 point is calculated as 1% of your loan amount. So $100,000 loan amount, 1 point would be $1,000 in that case. $500,000 loan amount, $5,000, right? And so the way points work are they're basically used to pull down the interest rate over the long term. So, and we're going to talk about a couple different types of points. So right now we're just talking about traditional buy downs, right? But a lot of people say, well, if I just pay a point, does that mean my interest rate goes down by a point? And it doesn't. The point is just the calculation of the dollar cost, right? How much it affects the actual note rate is dependent upon the market. I would say in a normal market, 1 point in general would move your interest rate by about 0.25 or 0.25%. In today's market, it's a little bit different, and there's a few reasons for that. So that's what a point is. That's how it's calculated. And then I think, is that what you wanted me to answer there, or do you want me to go into the 2-1 buy downs and the different kinds of points that are out there?
Yeah, can you kind of walk through like I just had a list, I just had a listing, and the buyer was trying to lock in her rate when that we kind of talked about this the week that everything was kind of like very volatile and up in the air, and she ended up having to pay a lot of money to buy down her rate and buy points. So can you kind of like walk through that process, and with the market the way it is today, what are some of the costs that you're seeing and things like that?
Yeah. And this is the part that gets really unique. And I mean, I've been doing it 20 years and it's unique to me. So let me, again, I always try to explain things without boring people to death or confusing them. Okay, in general, there's kind of a lifespan of a mortgage, right? So everybody thinks of a mortgage as I'm just going to a loan officer or a bank and I'm originating a mortgage. Once it's done, it's done, right? And then I pay somebody monthly and that's it. But there's a lot more to it. So a mortgage, as an example, someone like us, we do the mortgage, we process it, we underwrite it, we close it, we fund it, we do all of that. We might or might not service it over the long term, right? So we might what's called transfer it over to another servicing company who then you would just make your payments to. So there are times when it works like that. And now when you transfer it, generally whoever's buying that mortgage from you pays whoever's giving that mortgage over, because they didn't have to pay anybody to originate it. They didn't have to pay out anything in the beginning. So it's basically an easy way to pick up servicing, right? Well, in the background there, once it gets transferred, then it gets moved to Fannie Mae, then it gets converted to a mortgage-backed security. And there's all these different kind of points in which money is exchanging hands, right, between banks. And I won't go into the horrible details of all of that, but why that's important now. Okay, so you've probably heard of prepayment penalties long time. They haven't been around like pre-2008. And they were usually 3-year prepayment penalties. Well, everybody looked at those as bad because nobody wanted to pay, early. But the reason they came around originally anyway was that a bank truly needs to hold a mortgage for about 3 years in order for them to basically turn a profit on it, right? A profit that's worthwhile is the point. Not just getting back to zero, but, getting to a point where it was worth holding, right? So that's kind of where prepayment penalties were born, is to guarantee that that bank was going to hit that profit number, and then they in turn were willing to lend the money. So when rates are doing what they're doing now, which is kind of going up, not kind of, but definitely going up, what all the banks realize is that nobody is going to hold these loans for 3 years. right? All of these loans that we're doing now will likely get refinanced the moment rates come down. And that could happen by Q1 next year, right? I mean, at least a starting of that happening, right? And if that happens and all of these loans being done over the last 6 months get refinanced, all of those banks lose money. Okay, so the situation that you were talking about was, hey, I've got this buyer and they're telling him he has to pay all these points. Why is that? And in fact, I think they told you on that one day that they didn't even have the ability to lock it that day because
they're like, it's changing so much, we can't even lock it down.
Yeah. And so now paying points is more important than ever, because what the banks and the loans are doing is they're basically getting their money up front, because they know they're not going to have this money, this loan for a long time. And so the days of, what we used to call no cost refis, right? There's always a cost to a refinance. It's just who's paying that cost. And if you took a higher, or what's called a premium rate, then the bank could cover your closing costs because they were making more on the loan. Now, no one's doing that because they know they're never going to make that amount, even because they're never going to have the loan long enough to make that amount. So that's why these points are becoming more prevalent. Sellers picked up on this, and sellers really picked up that buyers' main pain point in the market is rates, right? I mean, that's the only kind of negative thing. Everything else is, gosh, you get the house for a lot cheaper. There's more inventory. There's a lot of reasons why being a buyer is a lot better now, other than the rates, right? And so they're like, okay, well, we can combat that. We're going to offer you, and it's significant amounts of money, right? $15,000, $20,000. And you can use that to either traditionally buy your interest rate down, which is forever, right? You were at a 7, now you're at a 6.5. Okay. And that's for 30 years. Or you can do things like 2-1 buy downs. Before I go too deep into 2-1 buy downs, I wanted to make a last point on your client that you're referring to. The issue that he was having, I'm guessing anyway, but I'm about 95% sure I'm accurate on this, is that what makes these times challenging is that as lenders, there's a lot of rules that we have to follow, right? There's, for example, one of them is you can't charge over a certain percentage of the loan amount in fees, right? You're not allowed to. They refer to that as predatory lending, and that is, in any normal market, is a great thing, right? You don't have anybody ripping people off, basically. So when the market was moving so quickly, I mean, the best that bank probably could offer was 3 or 4 points that they had to pay just to get that mortgage. And they're like, we can't even charge that much.
Right. Okay.
That's okay. But if there is no seller concession on there, that's not even a doable. That's not a Fannie Mae sellable loan, right? So no bank is going to do that. They're going to say, well, we just wait until we can. Right? It's really all they can say. And so that was probably the problem that you were having. And so now we flipped over to like a 2-1 buy downs. Well, we do some traditional buy downs, some 2-1. Those are kind of the most popular that you're seeing out there right now. Which the 2-1 buy down, I think we hit on a little bit last time. But basically, for the first 12 payments, your rate is 2% lower than market. For the next 12 payments, which is year 2, your rate is 1% lower than market. And then after 24 months is gone, now you're just at market rate, right? So, and the concept there is hopefully rates are down. Now we can refinance is the idea. And because sellers are now willing to play ball and give seller concessions and sell the house for actually less than it's valued at this point, we have room to make those maneuvers. And so I've been kind of telling people, it's like you can't have your cake and eat it too. You've probably heard that saying, right? It's like you get the low rates and the high cost of the house, or higher rates and low cost of the house, right? It's like one or the other. And we're just trying to find creative ways, in the meantime, to keep people's rates as low as we can. So
that makes sense. We have a question. This one's from my mom. Thank you for watching. Are the prepayment, first of all, are there any prepayment penalties anywhere right now? Are any banks doing them?
So in the what we call conforming or conventional world, like a normal mortgage you think of, a Fannie Mae style mortgage, no, there's not any prepayment penalties on those. We almost wish we had an option to do it because in this particular market it would be good, but overall prepayment penalties weren't a great thing. So it's better to kind of leave them off. Now, if you flip into like the private banking world, or what some people call hard money, you'll see stuff like that in there. You'll see higher rates, higher fees. They don't have to play by anybody's rules. They can do whatever they want. It's their own money that they're lending out. So
okay. And so prepayment penalties, they are legal. It's just banks aren't doing them.
They are no longer allowed in the Fannie Mae world. So in the
Okay.
conforming world, they're no longer allowed. And that was probably, 2010, something like that, somewhere in that realm. They pulled all those out. So they had what's called a qualified mortgage, or QM products, if you've heard the term QM before. And things like negative amortization loans. You remember the no income, no assets, no document loans.
Right.
Things like that were all taken out, and they were taken out for a good reason, because
Yeah.
that 2008, that's why everybody said, "Oh, are we in another 2008?" Absolutely not. Absolutely not. Now the economy is having problems, right? And that's true. But in 2008, the economy was having problems because the housing market screwed it up. Right? The
Right.
market screwed it up. They were the ones that had all these derivative products that were really not good. I don't want to go into all the minutia as far as why they were doing it. There was a lot of reasons why they were artificially trying to prop up the economy at this point, but they came up with some really bad ideas. Appraisal practices were not scrutinized at all. There was a lot of differences between back then and now. Now the problem is more global, right? It's not so focused on one industry, basically, but our industry, unfortunately, is feeling it, just like a lot of industries are, though. So yeah, I mean, everybody's feeling inflation for sure. So
Yeah. No, that definitely makes sense. Can you are people doing 30-year conventional loans right now from what you're seeing, or are some people doing those 2-1 buy downs? Is anyone doing adjustable rates? I've had some of my clients ask me about the rates for adjustable rate mortgage, and because of kind of what happened in 08, I'm just like, are you sure you want to? Do you want
yeah.
to do an adjustable rate mortgage? But what are you seeing?
So all the above is really the answer to that. So as we go through this time frame, it's shocking. People get very creative, right? You'll see banks come out with very aggressive ARM pricing, the adjustable rate mortgage pricing, and all of a sudden they get all the loans that they had an appetite for, and now their rates are terrible. So when the pricing is good, we jump on it. When it gets bad, we leave it alone. But again, everything we're doing right now is just so temporary. Everything that's being right now is just very temporary. I mean, you will find better products, but like a 2-1 buy down, just to explain it, I mean, a 2-1 buy down is a 30-year fixed mortgage, right? It's the same mortgage. You're just adding that feature on top of it, basically, right? Which keeps it down those first couple of years is really it. And the seller pays for it in that case, right? So if they're giving you closing costs, they can do that. So basically, you're just saying, "Hey, seller, pay a part of my payment for 2 years," right? And that's really what it is. It's as simple as that. And so, yeah, I mean, all the above, I would say. And I don't think an ARM is a bad idea. As long as you can find the right price on it. And so sometimes they come in and out, so it kind of depends. But in that same breath, an ARM is not something you want to be in when it starts adjusting, right? So typically you're looking at like a 5-year ARM or a 7-year ARM or a 3-year ARM. So that means it's fixed for that first period of time, the 3, 5, or 7 years, and then it starts adjusting after that. And when it starts adjusting, yeah, generally you don't want to be in that at that point. But we just feel like we'll be refinancing before then. So
yeah. So that's kind of what it sounds like. The main idea is like you're going to keep this low rate for the first 5 to 7 years, and after that, you should be refinancing by then, similar to the 2-1 buy down of like this will get you through these first couple of years so you can actually buy the property, and then after that you should be looking at refinancing.
Yeah, and that's the thing. Everything's trying to allow you to take advantage of what we were just talking about, the other benefits of what the market is, right? Like, I get it. We don't have rates that anybody is really, wanting at the moment, but there are great properties out there, and they are going for less expensive, and you are getting all your closing costs paid for. And so there's all these other things you're doing. So you're just trying to make that one section more palatable is really all we're doing at the moment. And then we wait. It's a big thing about inflation. I mean, if you want to oversimplify it, I mean, that's what we're all waiting to see, is not like inflation, but inflation peaking and looking like we're starting to get it under control. That's the biggest thing that we're all waiting on. And that's what the rate market is looking at. And as soon as you see that happening, you'll see rates topping out and then eventually coming down. At what speed? I don't know. Hopefully fast.
Okay, yeah, that was my next question is like, based on what you're seeing, do you have a prediction, or is it really just like no one has any idea right now?
So I'd love to take credit for it, but we go to conferences. I talk to people that are much smarter than me when it comes to rates. That's all they do for a living is analyze these. So of all the things I've heard, okay, so we talked a little bit about the CPI, which is Consumer Price Index. It's a inflation measurement that comes out. It's one of the most important things you see on all these, Fed talks and everything, right? They just had one that came out, I think it was last week. Yeah, it was last week sometime. And we knew it was going to be not good. We were optimistic that maybe it would show something not as bad, but it was bad, kind of like we expected. And that's the September numbers, right? So that in October, the September numbers are released. We are more optimistic in November when the October numbers are released. And you have to understand they're looking year over year, right? So when September numbers come out, they replace September of 2021 with now September of 2022. So now that year average is different. And because we just went through such a weird time economically with COVID and whatnot, some of these inflationary numbers that are being replaced with current numbers, you went from extremely low to much bigger, right? And so that overall year over year looks a lot worse when you're doing that. But now it's starting to get to the point where those inflationary numbers were actually getting worse back then, like at the end of last year. And so if it replaces it with a better number, then our year over year goes down. And so I don't, crystal ball cracked. Well, it's got a giant crack in it. It's had it for a while now, unfortunately. But I would say optimistically, we would see that first kind of ray of sunshine in November when the October numbers come out. And if not, man, I really think in December, every month that goes by, there's a better chance of it happening ultimately. Everything the Fed's doing to slow money moving around, to slow credit being given out, basically to slow, people having access to money, right? They're taking money out of the market. It just curbs inflation. I talked to a client of mine actually, and I've been a client of hers as well. She sells cars. And I said, hey, how's your industry, right? Like, I'm just trying to get a micro of one industry. Do you feel like the supply chain starting to work itself out? You're starting to get more cars? And she said, well, it's still not great, right? We're definitely not to pre-pandemic stuff. But yeah, it's starting to get a little bit better, right? We're starting to get more cars. They're getting more parts. They're able to do all the things that they need to do. And so that's just one example. But I think that's going to happen in a lot of industries. Just the supply chain issues that we had with COVID, that was a major problem as well. Eventually, as things slow down, that works itself out. So
that's interesting that you say that, because I heard the same thing from the car industry, that now we're starting to see dealerships going back to like offering cars below MSRP, and there's not the crazy supply and demand issue that they've been having for the past couple years. Because that's been so crazy. It's like, man, I bought a used car like 2 years ago, and I could sell it today for what I bought it at because of the supply and demand issues. And that's not really great for anyone who's trying to buy a car, or if you need repairs or you're trying to get parts or anything like that. Like, it's been extremely difficult. So it's good to know that industry is kind of loosening up a little bit.
And that's just one, right? And the whole microchip thing and whatnot. There's so much that goes into this, right? There's, endless, tributaries that feed into the river or whatever. But I knew we were going to talk today, so I wanted to ask that question from her. Like, one other perspective, since we talk about a lot of real estate, right? But it's always good to hear from other industries how they're doing. And so, I think the pool industry, same thing. I talked to a pool guy the other day. He said, man, I've been able to find these parts. I've been able to find this and that. And when you can't find them, they just charge double. That's basically, and then somebody's willing to sell it for double.
Right.
Yeah. So I think for a lot of reasons, we're in the worst pain of it right now. And I'm hoping that means we're hitting that top end, and eventually we're going to start working our way down. So.
Okay. I hope so. I see some people who are talking about, we're still just at the tip of the iceberg, and is this going to be another 2 years before we even get into it? And it doesn't seem like it's that drastic. It doesn't seem like what we experienced in '08. And we've talked about the differences between that, whereas there was just, like you said, '08 was pretty much driven by the housing market, and there were so many different regulations then, and people were buying houses who had no business buying houses, and all the changes happened. And so we've put a lot of things in place to prevent that from happening again. And now the housing market isn't the cause of it, but it's just being affected by it. Um, so yeah, I hope that this turn down, this recession, whatever it's going to be, isn't going to be as significant as the last time, because that was very impactful, like
Oh yeah,
for
no,
everyone, not just for
that
a few
one.
industries.
And I always want to make sure as I'm talking about things kind of turning around, recessionary fears are still there, right? I
Hmm.
mean,
Oh
so,
yeah.
like we're definitely feeling like we will be entering a formal recession.
Hmm.
The article I was reading this morning doesn't feel like it's going to be as bad or as sharp as the previous one, um, but it looks like we might. Now, I know this whole podcast, right, is more about the real estate side of it, and actually, mortgage rates generally are positively affected by recession, because the Fed starts making movements to pull rates down to try to
Hmm.
stimulate that section of the economy, which is a big section of the economy, which can kind of help bolster everything up and right
Hmm.
like move us out of the recession. And so right now it's just everything's being pulled back. Everything's being pulled back just to pull as much money as they can back. But if we do truly enter into a recession, they actually might then again start spending at that point, which and I just really think when it happens, it'll happen as quickly as the other side, right? I mean,
Hmm.
this all happens so quickly in our world.
Yeah.
Um, and I think a lot of people are kind of sitting back because they don't understand everything about the market, and that just makes them nervous. But as soon as you see the trend, that really, as soon as the news starts reporting interest rates are going down, I just feel like the same thing. All of a sudden, everybody's going to jump off the fence and run over
Hmm.
there. And so, the opportunity to get in there in a calmer world right now is there. I think it definitely gets more exciting next year. So,
Yeah, I totally agree. And that is one thing that we're seeing. I sent an email out to my clients yesterday, just like, hey, here's a general update on what's going on in the market. And Austin Board of Realtors releases their figures every month, and I kind of went back to, like, okay, you're giving me the year over year. We're still seeing price increases compared to last September, last August, last July, but where are we compared to, like, May? And what I thought was interesting is that we are seeing, like, significant price decreases even compared to like 3 or 4 months ago, whereas, like, I want to say in April or May, the median sales price in the Austin Round Rock area is 550. Now it's 515. So
yeah,
it's a $35,000 difference. It doesn't seem like a huge change, but when you think about how for the past 2 years it's just been like crazy skyrocketing in the other direction, a price decrease that big, like on average, is kind of telling. And it's what I'm seeing is basically our listings are either the same or they've dropped a little bit. Like, listings haven't really changed that much, but houses are taking much longer to sell just because there are fewer buyers in the market because of the interest rates. So when you
yeah,
talk about, like, yeah, if we're in a recession and interest rates drop, well, that's where we were at for the past 2 years. It was like, oh, let's boost the economy up because COVID and everything was dying, and let's boost it up and let's drop the interest rates. Well, that's that's how we got into this crazy mess, at least in Austin, to begin
yeah.
with. So you're right. Like, when interest rates go back down, those prices are going to skyrocket up because we're going to go back to that crazy supply and demand issue that we've been having for the past few years.
And I just because a lot of people don't see it, I wish I had the chart to show you, but this other meeting I was in, um, originally when COVID hit, the Fed was dumping money into mortgage-backed securities, trying to keep rates down, and it kind of pulled down a little bit. But then you saw them; it didn't have the effect they wanted, and then they dug deeper, and then they really dug deep. I mean, to the tune of like over $1 trillion in
Wow.
like a week and a half. I mean, wild stuff. The amount that they like artificially pulled that stuff on to make that happen. But I also wanted to make the point too that um, I don't want it to be confusing. Like the values are going down.
Right.
I think the sales prices do go down, but does the value go down? Because what we're effectively eliminating is buyers getting overcharged, right?
Right.
Buyers being forced to pay more than the value of the house. So the value, as far as where it was, people were buying it for more, but now they're
Mhm.
buying it just under value, right? So it overall, which is that's the data that you're tracking there, right? Like the median sales price, the sales
Mhm.
price is whatever the contract price was. That has no consideration of how much the buyer was overpaying, right? I mean, it doesn't have that
Right.
consideration. So I don't feel like, I think this, and that's what they more refer to as a correction, right? It's a
Mhm.
correction in the market versus the prices dropping. And so that, again, I mean, I obviously I'm a bank, right? We represent a lot of buyers, and so we
Yeah.
look at it from that perspective. But that's part of what you want people to understand is while we're in this wild section where you have some people who are more, scared or whatever it is to move around. That's where opportunity presents itself, right? It's
Mhm.
like, hey, do I sell my stocks? No, you buy more stocks at this point, right? I mean, if you have that ability, right? Now, if work's not going well or anything like that, obviously that can get scary. But if you do have that ability, now is the time that you want to be bold because this is the best deals that you'll see in terms of sales prices. So,
Yeah, exactly. And kind of what we kind of touched on this last time of you can, and you mentioned it, so you can't have your cake and eat it too. So you can either have very little competition. You get to take your time when you're trying to buy a house. You get to pick the house that's actually right for you. You don't have to overpay. But we also have high interest rates. Or we can have very low interest rates. There's a very high demand. You have to compete with 40 other buyers. You have to give away all the terms and you don't get any seller concessions, but you have lower interest rates.
yeah,
So it's not going to be a perfect scenario or in a perfect market. It just depends on what your specific situation is. And what I've been sharing with people is like if you can hang for a couple years with the payments, now's a great time to buy. And if you can do some of those options that you were just talking about, like a 2-1 buy down or like an adjustable rate for the first few years, then after that, or with the locked in rate for 5 to 7 years, then after that it becomes adjustable. Like that's another great option too. So I think it's just being creative and seeing what your options really are because like all across the Austin area, houses, like the average is that houses are selling for 95% of the sales price versus last year. This time last year, we were buying houses at 25% over the sales price.
right.
So, I mean, the listing price. So it's a really great time right now if the payments work for you. If they don't work, then they don't work, and now may not be the right time. But if you
And
can
that's
swing
what
them for
you're
a
doing.
couple years, like.
You're managing that risk, right? That's
Mhm.
what you're doing. You're using the advantage of the lower sales price or the seller willing to give a concession to
Mhm.
then reduce the risk on the payment being higher to you personally, so it keeps that payment lower in the meantime. And then, you're also making payments in the meantime. I mean, when you compare it to renting, it's just, I know sometimes, again, it's just that consumer confidence piece that we talked about again last week, but the difference between renting and buying is such a big deal. I mean,
Mhm.
what I always try to tell people is like, it's just like you're contributing to a 401k. Even if your mortgage payment is a little bit higher, every payment you make, part of that payment just goes in your other pocket, right?
Right.
You're just pulling it out of one pocket, put it into the other. Part of it goes towards interest, and the interest might be higher in the meantime. But if someone else is paying for it in the
Mhm.
meantime, not all of it, but some of it, then hey, well, okay, that's something. And I also saved 6 figures on the house price, so
Mhm.
it,
Right.
it it's you have to it's a longer term investment, right?
Yeah.
It's the same thing. Again, I always compare to stocks. It's like, oh my gosh, stock market's doing bad, should I pull out? I'm like, well, are you going to use the money now? No, I'm not using it until I retire in 15 years or whatever. Okay, well then it's monopoly money, right? Just leave it alone. Let this
Right.
cycle play itself out. And same goes with mortgages. It's like if you can find a real estate, you can find that value. You're not flipping it. If you're flipping it, it's a different story. But if you're not, you're looking years down the road, looking months down the road. At least you shouldn't be.
Mhm.
Yeah.
Yeah, like this is a long-term game, and that I talk to people about that too. Like, oh my gosh, what happens if the prices go down or if the value goes down? Like, that's a possibility. Do you plan on selling it in a year? Or is this a house you're going to have for 5, 7? 10 years down the road, because those are two totally different strategies and different considerations to keep in mind. But yeah, like if you're buying real estate for the long term, there's going to be peaks and valleys. There's going to be ups and downs, just like in the stock market. But you don't sell when it's down if you can avoid it. And that's the hard part. Is I think a lot of people, maybe for folks who don't know how long they're going to be staying in this house, they may be relocating for work and things like that. Then that's a bigger risk. But if those risks aren't there for you, there's going to be ups and downs with every market. It's not going to continue just shooting up and up and up, no matter what investment you buy. And just being able to weather that, and knowing your acceptable level of risk is another big factor too.
Yeah, absolutely. And looking at your family budget, like your household budget, in other words, how do you feel about your job, what you do for a living, and do you feel pretty stable about it? I mean, there's a lot of things that would go into kind of calming those fears a little bit. And I think they're all things you should think about, because believe me, I have several clients that their industries are not doing bad at all. I mean, they're still thriving. There's still things that are happening. I mean, you look at every skilled labor out there, right? Every plumber, every electrician, all those guys, it's gangbusters. I mean, they are in huge demand still.
They could be working 24 hours a day if they wanted to.
They absolutely could, right? And I mean, that's just one example. But I mean, you look at it, right, and you say, am I truly worried about it? What reserves do I have? You look at, are I having kids and the kids' ages and the schools and this and that? It's like, okay, if this is the moment where we can, position ourselves where we want to be, let's go ahead and get in there, And I mean, again, buying a house last year was just so challenging, for buyers. I mean, just everything they had to go through to get it. It's like, well, that's great. The interest rates were low, but a lot of them are like, man, I don't even really like this house anymore. I didn't even know what it looked like before I bought it. There are definitely things. They are. Like I said, I think the rate thing, it will turn around. I mean, it historically will always turn around. And when it happens, I think it happens pretty quickly. So,
well, at least that's one thing for us to look forward to. If we are heading into a recession, that rates might go back down to get everyone back into the housing market. So, well, and there's reasons why that happens, but I think it definitely would happen. And the problem though is as soon as that demand goes up, sales prices go up, right? So it's like the have your cake and eat it too thing. I keep saying that. It's like, as soon as this happens, this is going to happen, And so you're just trying to figure out which, what is your timing? What is your sweet spot? And then get in there when you can. So, Awesome. This has been awesome and very enlightening. Thank you for the explanation about the points and everything like that. Is there anything else that you want to leave people with, or make sure you want to get across, or where can people find you if they have more questions about mortgages, interest rates, all that good stuff? How can they get in touch with you?
So you guys can always email, call. Obviously, if you know Tiffany, you can send to my way too. So we're with Supreme Lending here in Austin, Texas. My phone number is 512-279-1140. So you can always reach me there. You can always email me at josh.flores@Supreme Lending. We're having a lot of these conversations, so if this is something that piques your interest, I mean, this is every day for me, right? Every day people are calling and they want this explanation. They want to understand kind of what's going on. I mean, if you're interested in buying, trust me, there's a lot of reasons that you can right now. And if you want to wait after that conversation, always fine. It's totally up to you guys, but that's what we're here. I mean, the idea is we just want to educate you guys and then let you, make a decision from there. So.
Awesome. Thank you so much. We're going to end this broadcast, and then Josh will be back in 4 weeks, and we're going to check in and see what's going on with the market then. Hopefully we have really good news, and we can talk about the October numbers are in and they're much better and interest rates are going back down. So we'll see. Yeah, we'll keep our fingers crossed for that.
Well, thanks for having me on. I appreciate it.
Yes.